Hey there, future homeowners. Are you ready to buy a house in 2025? Look, you don't have 20% down. You don't even have 10% down. And that's why in 2025, we're going to discuss the 3.5% down, the FHA loan, whether you're buying a single family or 2 to 4 units, how this loan product can literally get you into a home. Also, we'll go through the nuts and bolts. We'll break it down in English and get rid of all that gibberish that you might not understand, so you can understand how to use FHA in 2025 to your advantage, any changes that are going on, and also how this is benefiting and helping so many people get into homes with 3.5% down, great rates. Yes, there's mortgage insurance, but hey, the good thing, what I love about this loan is if you lock in a rate and let's say the rate's higher than you want, when you go to refi in the future, when rates come down, they have a streamlined refi. That means you can refinance the loan, you redo the loan again to drop the rate, which will drop the payment. It's one of the easiest loans to refi. No income, no asset, no appraisal. Literally slam it through in 7 to 10 days. It's one of the best products out here for first-time home buyers. That's why you're watching this video, and today that's why I want to go through with it, so I can make sure you understand it and how you can use it to your advantage in 2025 to get yourself into that home that you're looking to buy. And if you don't know me, my name is Kenny Simpson. I focus on 1 to 4 unit financing. That means I help people buy 1 to 4 unit properties and refi. I've been doing this 20 years. Yeah, long time. Helped over 5,000 customers do this. Probably need to recount. It's many more than that. And also funded a couple $1 billion of loans. So we've done this a lot. We've helped a lot of clients. And why you're watching my YouTube channel right now and you're watching this video is because I make content to help educate the future homeowner, to help educate, to understand and break down all this jargon here in the real estate business and the loan business to help you understand what is it you're getting into. Make sure you understand the products, how they work, what the requirements are, and hopefully give you confidence and encouragement to get out there and become a first-time home buyer. Or remember, with the FHA loan, you don't have to be a first-time home buyer. You can be a repeat buyer. You can use this product many times, but you cannot have 2 FHA loans at once. But a lot of clients have bought with FHA. Maybe they went to a conventional, made that property investment, and come back to FHA and buy another property. If that's something you're looking to do, well, we can help you with that as well. The FHA loan is a great loan, especially if rates are a little bit higher. The rates typically are lower. And honestly, some of the things that people don't know about FHA is it's a minimum of 3.5% down. The second thing is you can actually get an FHA loan with credit scores as low as 500, even though it's tougher, it's a manual underwrite, but 580 and moving up above, they don't really whack you with too much. When your credit score is lower, like conventional loans, you can get really punished on the rate. So FHA, even though you have a 580, the pricing can see be much more competitive. 580, 600, 650, 660 credit score, much more competitive if you went conventional route, put 5% down. Obviously, you have that mortgage insurance always because you're putting 3.5% down. Also, what I love about the FHA loan is you can also, the debt to income, right? So that's how much debt you have compared to how much you make. When you divide that in, you can go a little bit higher than the conventional mortgage. So the FHA is really meant to help that first-time home buyer that doesn't have much down, maybe not a lot of liquidity in the bank, but you're renting and you're paying a lot of rent and you're tired of making your landlord rich, or just tired of renting in general and you want to get out. Maybe you're starting a family, maybe you had a baby, maybe you got engaged, maybe you just got married and it's time to buy a house. This is a great product for anybody that is looking to do that. With 3.5% down, you can have the lower credit score. It's a win-win all around. All right, so now let's bust some FHA myths out there. That's total misunderstanding. Number 1, you have to be a first-time home buyer to use this program. Wrong. Number 2, you could have never had an FHA loan prior. Wrong. Number 3, you cannot own a primary residence currently that you're going to move out of and maybe you have a conventional loan and buy another one. Wrong. The one thing that I will tell you is if you have a primary and you're going to rent it out and you need to use that rental income, this is really, really important because a lot of people miss this, even lenders. You have to be within a certain miles range. So that mile range, you have to be within 50 miles. So if you have a home now and you're going to buy with less than 50 miles, they are going to hit you for your principal, interest, tax, and insurance if that's what you have on your current residence, and you cannot use that rental income to offset that. So keep that in mind because that's a deal breaker for a lot of people. And yes, the other myth is, and this one's true, FHA has lower interest rates than a conventional mortgage out there, like VA. VA and FHA typically have lower interest rates than conventional mortgages. So let's talk about down payments with FHA, right? So down payments with FHA is 3.5%, but there's a caveat to that. If your credit score is less than 580, you have to put down 10%. So keep that in mind. Plus, if you put down 10%, you also have to have money for closing costs. Remember, there could be buy down points. There could be title, escrow, impounds, taxes, insurance, closing costs. Make sure you factor for closing costs. I would factor probably 3% because this product does require you to open up an escrow account. That means you have to impound taxes, insurance. So in your payment, there's principal, interest, taxes, insurance, right? You have to impound the tax insurance. Depending on the time of the month, they could ask for 3 months upfront of tax insurance or up to 9 months. So make sure when you're getting pre-approved with your lender, you're going through this, you know, when you're going to think you're going to buy, when you're going to close, you can put together a nice loan estimate. So you have all the fees and this is all broken down. So mortgage insurance is something that can bother people. You hear people say, oh, I want to put 20% down to avoid mortgage insurance. I heard it's bad. It's terrible. Guys, it's not bad. Mortgage insurance it's like car insurance or house insurance, you know, or anything. And the reason why you have it is because obviously you're putting less than 20% down. And statistically, people that do that, if you don't pay or whatever, that insurance helps cover the lender, right? The servicer, the person that owns your mortgage. So with that being said, let's talk about a little bit of mortgage insurance, why it's not bad, and how it works with FHA. So FHA requires you to put down, when you close a loan, you can finance it or come in with the money. They charge a one-time upfront fee of 1.75%. And then on top of that, they're going to charge you a monthly fee, either 0.55 or 0.50, depending on how much you put down every month in your payment. And that's why, because you're putting less than 20% down, they need to make sure you have the insurance there. And that fund needs to have enough money in there for people that there's foreclosures or short sales or people that don't, have problems with their mortgage or cannot pay off their loan, or, they lose their job or go into foreclosure or short sale. They have to have enough money in that fund to cover those losses. If not, then we'd never have this product. You couldn't use it to become a homeowner and make it much easier to get into a home. So what most people do with the FHA mortgage is they'll go ahead and refinance out of it with a conventional loan. That way, if you buy a property, it either gets more equity, they can refinance with a conventional loan, get rid of MI, and that's a great thing. Conventional loans typically do have a lower mortgage insurance. That is depending on your credit score. So if your credit score is lower, then mortgage insurance with a conventional loan will be higher. If your credit score is much higher, you would get a much lower mortgage insurance. So really, when you're looking at FHA or conventional, the best thing to do is when you get pre-approved with a broker like me or lender, you want to explore your options like conventional and FHA to see which one is best. So let's do some quick math here. Let's just say you're going to buy a home for $800,000 and you're going to put down 3.5%. So it's $772,000 loan. So what they're going to do is they're going to say times 1.75% equals $13,051. So $13,551 is the upfront fee. I would say 99% of people do not pay that out of pocket. They finance it in. So that would get tacked on top of your loan balance that you have. And you would just finance that in, and FHA allows you to do that, which is great. So you don't have to come in with that extra money. One of the cool things about FHA, a lot of people use, it's harder here in a place like California, but other states, is if you ever heard of house hacking. House hacking is either you have a single family, you rent out the rooms, or you buy let's say a 3-unit and you live in one and rent out the other units to help pay for your mortgage. Well, you have to pass the thing in FHA. It's between 3 and 4 units. It's called a self-sufficiency test. So I'm going to try to break this down simple and in English you understand. So what that means is basically, think about it this way. Let's say your payment is $5,000, right? $5,000 for your 4-unit in another state. Okay. And let's say if you rented all 4 units and you didn't live there, you would get $5,000. Okay. The problem is that would not pass the self-sufficiency test, because what we would do is we take $5,000 and then we would times it by 0.75, and that's $3,750. Well, $3,750 would be the rent that you would get when you take 75% of it. That would not cover your mortgage payments. So what FHA is looking for you to do is pass the self-sufficiency test. And what that really means is that the gross rent you could get if you just kept this property on it, all 4 units, and rent it out, and you get your $5,000, at 75%, it has to make more money than your mortgage. In California, it's very hard to do. Other states, it's definitely doable. So the great thing about FHA is if you go 1 to 2 units, that is not required. But if you go 3 to 4 units, that self-sufficiency test required. So remember that. If you need more explanation on that, have a scenario, please hit me up. In the description below, you can contact me anytime, call me, text me, email me. But it's a great product because if you wanted to buy a 4 unit and live in one or rent out the others, if you can qualify and pass the self-sufficiency test, you can put down 3.5%, and this could be a great product, game changer for you, your family, into letting somebody else pay your mortgage payment. So one of the things that is changing with FHA in 2025 right now, we do have a new administration coming in, so we might have to update this video. Maybe there'll be more changes, but right now, the only thing that really changed is obviously the loan level limits across the board change, whether it's conventional, FHA, or VA. So if you want to get that chart and look up where you live, what the loan level limits or FHA are, look in the description below. You go ahead and click on that link. We'll have it in there where it gives you the loan level charts, and you can put in your state, and you can see what exactly the loan levels are, whether it's single family, 2, 3, 4 unit, and see what you can qualify using this product. So here's the deal. When you're thinking about FHA loan, just think about it is like a first-time home buyer, but you don't have to be a first-time home buyer. Think about it. It's just a very good vehicle to get you into a house for minimal down. If you have a little bit challenging credit score, if you need to get a little bit higher DTI, that means, remember, your liabilities divided into your income. If you need some help and your maybe credit's not as good, this is a great product to help you get in the house. If you're a first-time home buyer and you just don't want to put 5% down, you want to put 3.5% down, this works out better. This is a great product. It's there to help people get into their home, give the best rates that are out there, make it possible to create home ownership for you and your family. You just want to make sure whether you're getting an FHA loan, a VA loan, a conventional loan, whatever the loan is, you work with the right lender, the right team, and the right experts so they can guide you through the process. They have a lot of knowledge about the product, and they can help you out, get into your first-time home and make that happen. If you're ready to explore options and look at whether an FHA is better or a conventional loan is better, or whatever you're looking to do, maybe you want to buy a 2 unit or 3 unit, please, in the description below, go ahead, call me, text me, you can email me. You can also schedule time to talk. If you have any comments below, share this video with somebody, but I do appreciate you watching. If you want to get more information like this, we put out a lot of great content, and you're in the home buying process, maybe you're a real estate investor, as you can see through the channel, we talk about a lot of different things. Like, subscribe, so you'll get notified when we put out a new video. Anyways, thank you so much for watching. We'd love to hear from you. Have a great day.